Hello again, options traders, and what is happening, everyone? Well, this video is going to be just a little bit different from what I normally do, which is usually on options and strategies and things like that, but it is related, and it's how to calculate rates of return. It's a question that I do get a lot because traders want to know, after all, how am I performing with my options strategies? How is it doing compared to the market? And so you need to know how to calculate the rates of return. So yes, there's a little bit of math, but don't get too frightened. It's actually pretty easy. So again, the main reason that we're trying to go through these motions is that we want to determine if one trade performed better than another. That's the basic idea. And to do that, you should compare rates of return. Now there's a couple of ways to do it. You can use what's called an actual return or the percentage change. So for anybody who knows how to just do a basic percentage increase or decrease, that's all it is. And then the second way is called an annualized return. And what we're doing here is we're just pretending that this actual return occurred throughout the course of a year. What would you have at the end of the year? So let's start with the actual return. And sometimes this is called a total return, which is not really accurate. A total return is usually the capital gains that you've earned plus dividends, plus really everything that you received from that asset throughout the year. But what you're going to do here to calculate this is you're going to take the selling price divided by the purchase price. I'm going to start there. So let's say that you bought stock at 100 and you sold it for 115. So ending price divided by the beginning, 115 divided by 100 is 1.15. That's just telling you that your selling price was 1.15 times higher than your purchase price, or 15% higher. So if you want to go through the actual steps to get to that, you would subtract 1 and multiply by 100. So 1.15 minus 1 gives you 0.15, multiply by 100, and there is your 15%. So that gives you a number, but the big question, is this a good return? So how many think that this is a good return? You should see it's a little bit of a trick question. If trader A makes 15% and trader B makes 10%, did trader A actually outperform B? See, we don't know. We can't really tell if it's a good return. We can't make comparisons unless we know what? Unless we know the time frame. If trader A made 15% over the course of 5 years and trader B made 10% in a month, trader B vastly outperformed trader A, even though if you just look at the numbers, A's numbers were bigger. So this is why we need to bring in kind of an element of time, and we do that by annualizing. So technically, all of your returns are based on a 1-year period. So if you see a bank advertising that it pays 3%, that is per year unless otherwise stated. If you see a credit card charges 29.99%, that is per year unless otherwise stated. And part of the reason that's done is so that people can make comparisons, right? If a bank says that it pays 5% for a CD and somebody else says that they pay 3%, but that's for a quarter, you're not making equal comparisons. So to do that, they always base it on a 1-year period. So again, what we're trying to figure out is how long did it take to earn this? That's important. So if you earned this 15% return in 6 months, that's not a year. And that means that 15% return is actually better. How much better? Well, it's very simple. You're going to say how many 6-month periods are in a year? Well, there's 2. So that's what we call our annualization factor. We're going to take this 15% return times 2, and we would say that you earned 30% on an annualized basis. So again, does this really mean that you earned 30%? No, you earned 15%. But what we're saying is that if you continued to earn at this rate over the course of a year, it would be 30%. That's what the annualized figure shows you. So this example was fairly easy. I think most people can see that you would just multiply by 2. But what if it's not so easy? What if they're not such nice, neat, round numbers? Well, the math is still logically the same. What you're going to do is to take 360, number of days in a year. You could also take 365. and you divide it by the number of days that you held the position. And that's going to give you that annualization factor. So let's say that you earn this 15% in 60 days. How do we annualize it? Well, we take 360 days in a year divided by the 60 days that you held the investment, and that gives us 6. So once again, this becomes our annualization factor. Take the 15% straight up return times 6, and we would say that you earned 90% on an annualized basis. What if you earned 15% in 42 days? Again, 360 days divided by 42 gives you an annualization factor of 8.6. Take the 15% times 8.6, you earned at the rate of 128% per year. Well, how do you annualize if the position is held more than a year? It's really just the same idea. Let's say that you earned 15% in 1.5 years. Take the 360 days in a year divided by the number of days you held the investment. It's always the same formula. Now in this case, we got 0.6666. If you start getting decimals like this, it's a good idea to expand them out. So that's 2/3 of a year. Now we could also get there a little quicker by saying 360 days is a year divided by 1.5 years. Same thing. So that becomes our annualization factor. Take the 15% times the 0.6666 and we get 10%, which should be somewhat intuitive. If you earned 10% in a year and you continued to earn at that rate, you would earn another 5% in the next half a year. So that would be your 15% in a year and a half. So to summarize, if you earned 15% in 1.5 years, you should say that you earned at the rate of 10% per year. That's your annualized return. Okay, so what if you ended up with a loss? Well, it's always the same formula. Take the selling price divided by the purchase price. So if you purchased, let's say, shares for $100 and sold them for $87, take your selling price of $87 divided by the purchase price of $100, that gives us 0.87. So what this is telling you right here is that your ending investment is 87% of the starting point, which is to say that you've lost 13%. But if you go back to the original formula that I showed, what was the next step? You had to subtract 1. So if we take 0.87 minus 1, there's your minus 0.13. So see, it's pretty cool. Even the formula comes up with whether it's plus or minus. It actually shows up as minus 0.13. So again, that would just be a 13% loss. You can also use these formulas for your entire portfolio. So let's say you've got whatever, $100,000 on January 1st, and with all of the trades, gains and losses netted out, it increases to $125,000 on December 31st. Well, we take the $125,000 ending balance divided by the $100,000 beginning balance, and that equals 25% on the entire portfolio. So if you had earned this $125,000 after 6 months, go right back to annualizing it. It's always the same formulas. Now keep in mind that for the portfolio, this is the more meaningful return. Yeah, you're going to hear about people that say, I earned 375% on an options trade. Well, sure, anybody can buy an option for $1 and sell it for $3 or $4, and the returns look fabulous. And those happen quite often, but so do losses. So if you think about it, what you're really interested in is the entire portfolio. Now, technically what you should do is compare this return that you got to the S&P 500. So if you return 25% on your portfolio after a year, but the S&P 500 returned 30%, well, then you didn't do so hot. You could have earned a better return from passively investing in the S&P 500. So you always want to make a comparison to the S&P 500. Now, having said that, it's not really quite that easy, because technically you should do what's called a risk-adjusted comparison, and that's a whole different calculation. But the idea is fairly simple to show. If the S&P 500 returned 10% at the end of the year, and you earned 11%, but you did it by buying lottery tickets, should you really say that you beat the S&P 500? Well, most people would say for that extra percent, you took way too much risk, and we would actually consider it as not having done so good. That's what we mean by a risk-adjusted return. But at least it will give you a benchmark. Always go back and see how your portfolio did, even at periods in time, quarter, semi-annually, annually, and compare it to the S&P 500. So I hope that helps you to understand the basics of how to calculate your returns on individual investments, as well as your entire portfolio. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.